Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 274 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to be talking about something that even the Federal Reserve is worried about right now, and that is the rise of stablecoins. And stablecoins have a lot to do with cryptocurrency, and I'll get into all the minutia with you today and explain to you what stablecoins are, how they're being used, and exactly why the Federal Reserve is worried about them. And we'll really dig into whether or not stablecoins are something that you should be using in your own financial life. And we'll also talk about why they may be an issue for the people who are using them right now. So stick around for all that and more in today's episode. Before we get started, though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards some long-term financial goals that you have for yourself, and then ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who is watching or listening to this show on a day-to-day basis. Now, yesterday afternoon, the Federal Reserve released their minutes, right? Or their basically what they talked about in their previous meeting, right? And the Federal Reserve officials discussed the potential threat that stablecoins could have on financial stability. And you may say, well, what in the world is a stablecoin and why does it matter? Okay, why does this matter to financial stability? Why does this matter to our economy? Why should I be concerned about a stablecoin? So before we get into why the Fed is so concerned, let's talk about what stablecoins are. Stablecoins are a type of cryptocurrency. So first and foremost, a type of cryptocurrency that is built to offer more stability than other cryptos because it's backed by assets like the US dollar or gold. Other cryptos such as Bitcoin aren't pegged to a stable asset. Their value is derived from a combination of peer-to-peer technology and software-driven cryptography. Okay, so basically, what are these? These stablecoins, they are just these more stable versions of cryptocurrency. And so let's talk about exactly how they work. Stablecoins are backed by multiple sources, including fiat currency, meaning like the US dollar. A fiat currency is just a currency that has no backing, right? We just have dollar bills, or we just have electronic currency. We don't have anything that is behind the currency like when we used to be on the gold standard. It can also be backed by other cryptocurrencies, precious metals like gold, and algorithmic functions. But a crypto's backing source can impact its risk level. A fiat-backed stablecoin, for instance, so this would be like a stablecoin that is backed by the US dollar, may be more stable because it's linked to a centralized financial system, which has an authority figure like a central bank, so our Federal Reserve. And so you're going to see a lot of these overlapping lines here that the Federal Reserve is worried about this because it's, more decentralized, and yet it is relying on their centralized currency. Anyway, that central bank can step in and control prices when valuations are volatile. Stablecoins that aren't linked to centralized financial systems, like a Bitcoin-backed stablecoin, may change drastically and quickly, in part because there's no regulating body controlling what the stablecoin is pegged to. Okay, so these stablecoins are places where people are going to try to make returns, right, to try to put their money into some asset that is going to provide them some interest rate, some return, right? But that return is more stable. Okay, they don't want this super volatile return that other cryptocurrencies are offering. They don't want to just leave it in the dollar and get nothing. They want to make some good interest rate that is relatively stable and that is backed by something that is also relatively stable. Okay, so these fiat-backed stablecoins are described as an IOU, right? You use your dollars or other fiat currency to buy stablecoins that you can redeem later for that original currency like the dollar. Unlike other cryptos with value that can fluctuate wildly, fiat-backed stablecoins aim to have very small price fluctuations, but that's not to say that stablecoins are a total safe bet. They're still relatively new with a limited track record and unknown risks that should be invested in with caution. The cryptocurrency exchange Coinbase offers fiat-backed currencies called USD coin, which can be exchanged at a 1-to-1 ratio with the US dollar. Okay, so that's what a fiat-backed stablecoin would look like. Then what about the crypto-backed stablecoins? Well, these are backed by crypto assets like Bitcoin. Because the backing asset can be volatile, crypto-backed stablecoins are over-collateralized to ensure the stablecoin's value. For example, one crypto-backed stablecoin may be tied to an underlying crypto asset worth $2. So if the crypto asset loses value, the stablecoin has a built-in cushion and can remain at $1. So yes, this maintains stability, but it doesn't maintain total stability because still, if you lost that $2, you lost that $2, right? So it's interesting here that we're taking this differing amount of crypto that's underlying and the stable coin that you want to go ahead and put your money in. Now, that said, if you did change that amount back to crypto, then things may work out in your favor. These assets are less stable than fiat-backed stablecoins, and it's a good idea to keep tabs on how the underlying crypto asset behind your stablecoin is performing. Because as it performs well, then you could cash in your stablecoin and be a part of some of the gains. If it hasn't done so well, then you still have your stablecoin that is backed by this particular crypto asset. But if the asset is too volatile, then you will see some other issues arise. Now, precious metal-backed stablecoins, these could be backed by things like gold. Algorithmic stablecoins are backed by really any asset, perhaps making them the stablecoin that is hardest to understand, right? They use a computer algorithm to keep the coin's value from fluctuating too much. If the price of an algorithmic stablecoin is pegged to $1, but the stablecoin rises higher, the algorithm would automatically release more tokens into supply to bring the price down. If it falls below $1, it would cut the supply to bring the price back up. How many tokens you own will change, but they will still reflect your share. One algorithmic stablecoin is Ample, AMPL, and I'm not suggesting you use it. I'm just saying that would be one particular example. So, again, why do we care? Why are we talking about these stablecoins? You're like, Dylan, you're talking about stablecoins. I don't know why I would be interested in this. Well, we need to understand why people use these. The interest in stablecoins is that they can withstand volatility in a way that other cryptocurrencies aren't able to, but they still offer mobility and accessibility. A more stable cryptocurrency that is decentralized, meaning it isn't beholden to the rules and regulations of a centralized system, is attractive for other reasons. Faster money transfers, access to financial services without applications, keeping financial data private and avoiding financial service fees. Centralized stablecoins provide a digital option with the backing of a traditional currency. And like I said earlier, these stable coins are going to offer some interest rate that is going to be greater than what you could find otherwise in most cases. Now, some of the fiat-backed stable coins, I mean, I think on Coinbase right now, the USD coin is just 0.15%, which is less than some of the high-yield savings accounts that you could find out there right now. But if you look at some of the crypto-backed stable coins, then you're looking at 5, 6, 7, 8%, which could be something that is really, really attractive to individuals. So let's jump back to talk about the Fed. Okay, why does the Fed care about this? Participants at the Fed meeting said that these new financial arrangements appear to have the same structural maturity and liquidity transformation vulnerabilities as prime money funds, but with less transparency. And less transparency is typically not a good thing. Specifically, they highlighted the fragility and general lack of transparency associated with stablecoins, the importance of monitoring them closely, and the need to develop an appropriate regulatory framework to address any risks to financial stability associated with such products. Stablecoins, as I've told you, are digital currencies tied to assets such as the US dollar that don't fluctuate much in value and thus are more consistent in pricing than cryptocurrencies, which are increasingly popular but highly volatile. We know how much Ethereum and Bitcoin just fly all over the place, up and down every single day, and that's not to mention the smaller altcoins, which fly up and down every single day as well. Jerome Powell, who is the Fed chairman, I've talked to you about the Fed chair before and exactly what he does. He's previously said that a U.S. central bank digital currency could eliminate the need for cryptocurrencies and stable coins, such as the USD coin. So this is something where it just seems like the Fed is looking for a way to maintain some control. They obviously want to maintain the stability of our financial system, which overall is a very, very good thing. It's a very good thing that we do maintain some financial stability. But in doing so, it sounds like they'd be willing to take some options off of the table for some investors who want to get in there. Now, again, I haven't really gotten to a practical application use for you guys, right? But I've kind of told you where these things are coming from and what's going on with them, exactly what they are. But I want you to understand some risks, and then I want you to understand how people are talking about using them and why maybe you should not be using them in that way. So what is the catch of a stable coin or these crypto savings accounts? Okay, now that's kind of a hint as to where I'm going with this, but these are being seen as crypto savings accounts, and earning 5 to 8% seems fantastic, right? If I can earn 5 to 8% and have as little risk as possible, then that seems like a good deal, right? But the risk associated with these stable coins is going to be far different than the risk associated with just a high yield savings account, right? The risk here is going to be greater. And so we need to talk about those risks. Okay. These risks don't necessarily mean that crypto savings accounts are a bad idea or a bad product. However, you should only invest in cryptocurrencies like Bitcoin or using a crypto savings account if you're fully aware of what could happen in the worst case scenario. So let's talk about it. So first of all, no FDIC insurance. Now, what happens with FDIC insurance? What is this? Okay, well, the FDIC is a governing body that oversees our banking system. Okay, and with traditional savings accounts, customers are protected up to $250,000 per account in the unlikely event of a bank failure. So if a bank completely goes under, or you get money stolen from you from your bank, right, you are covered up to $250,000 by the FDIC, and they will, make sure that it is made right one way or another, and you'll be able to keep your money. Okay, but with crypto assets, this protection is not available. Right? You don't have any protection against some fraud occurring. You don't have any protection against this particular currency no longer existing or the platform on which you're purchasing it no longer existing. You have no protection. This means that if the company offering the savings account does not provide the private keys associated with the wallet where the savings are held, then it's possible a user's fund can be lost if the company goes under. Okay, so this is a big risk. This is something that definitely needs to be taken into account. Now, why is this super important? And this is really one of the reasons why I want to talk about this, because some people are using stable coins and crypto savings accounts for things like their emergency funds. And I just don't think that's a good idea, right? We have no control over the cryptocurrency market, right? The cryptocurrency market is extremely volatile. Okay, it is still extremely new. It is not FDIC insured. Okay, whereas we could put money in a high yield savings account and know that it's going to be there and know what's going on with it, right? That money will be there for the future. But if you put money away into a stable coin or to some crypto savings account, you have no idea whether or not that money is going to be there in 10 years. Okay, but I know if I put money in my bank that that's going to be there in 10 years. Now, I'm sitting here talking like, that one amount of money for 10 years or whatever, do I not want to ever grow that money? Do I not want to ever add to that money? Whatever. Well, I've told you before, with an emergency fund specifically, which is really the only thing that we're worried about when we're talking about saving money. Now, we can save money outside of an emergency fund, but let's just start with the emergency fund, right? The emergency fund is insurance against tragedy, right? It is ensuring that if something were to happen to us, that we can actually have some money to not go into debt for whatever it is, right? We don't have to put things on credit cards. We don't have to, go into bankruptcy. We can just pay for things on our own and move on. Okay, but think about if you were trying to do that and yet you couldn't get your hands on the money that you wanted to get your hands on, or not the full amount of the money that you put away, or something happened to that money. Maybe you didn't need it yet, but something happened to that money, or something happened to that crypto savings account or that stable coin or whatever. And now you're looking up and you go, oh, well, I just don't have that money anymore. Even though it seemed nice to make 5, 6, 7, 8%. Putting your emergency fund at risk is just not something we should be doing. There is always a reason that you are being paid interest, okay? And interest has everything to do with the amount of risk taken, okay? I teach this in an undergraduate finance class. What I teach has to do with risk premiums, right? And it has to do with the risk-return relationship. And basically, any financial instrument that is paying you any type of interest is doing so based on the fact that there is more risk associated with it, right? You can look at the banking system and you can find the prime rate and you can find the discount rate and you can find those risk-free rates of return that can be gained, those short-term treasury rates. And that is at the lowest end of the amount of risk that you could take, the amount of return that is offered to you, okay? But anything above that is going to be associated with more risk, okay? So if you're making 5% on some crypto savings account and your high yield savings account would offer you 0.5%, then there's a 4.5% risk premium associated with this particular type of product. And so what that means is there is enough risk associated with it that you would add 4.5% in the way of returns on top, because that is what an investor is going to require to put their money there. They are simply trying to drum up business by increasing the amount of interest offered, because there is inherent risk associated with it. And some of that risk does have to do with investors not being well versed in cryptocurrencies, not being well versed in stablecoins or crypto savings accounts. And so that makes a little bit of sense, but there has to be some other type of underlying risk associated, or else they wouldn't just be offering these rates of return, right? There has to be something on the other side where they are taking risk, whoever they is, right? The BlockFis of the world and the Coinbases of the world and the DeFi, just whomever, right, must be taking some type of risk. And if they're not taking a particular risk, then they're not going to be offering you as much in return either. Because you have to think about it. A bank, right? When a bank is going out and they're lending money, and they can lend money at 5, 6, 7%, right? And they'll offer you commensurate rates on your savings. Okay, they'll say, okay, let's increase their savings to a 1.5% high yield savings, or 2% high yield savings, or whatever, right? But let's say, as it is right now, they're making home loans, and these home loans are less than 3%. Well, you're going to get almost nothing on your savings, because they have to make money on the other side. And you have to know that that type of thing must be going on with these cryptocurrency sites as well. They're having to make money on the other side. And the fact that they're offering you 5 to 8% on some accounts on your side means that there is so much risk associated with it that they're making more, a fair amount more than 5 to 8% on their end, and they can just pay you some of that out of their pocket. So you have to understand that there's risk associated. Another risk is loss of control. According to cryptocurrency expert Patrick Moore of Crypto What, another major downside is the fact that you give up total control of your cryptocurrency assets. Okay, Moore points out that acquiring a crypto savings account means that one has to relinquish their account keys to the lending body. Since the whole crypto system is decentralized, the risk of shenanigans is actually quite high. If the administrator of your crypto savings account lends money to third parties and is never paid back, like I was just saying a moment ago, you'll lose all or part of your assets with no recourse. Again, if there is no guarantee by the FDIC, okay, and you know that they must be trying to make money on the other side, and they're doing so by lending out crypto, lending out money on the other end, okay, if they don't make their money back, then they can't pay you. Okay, and this is a problem. Now, in a normal savings account, the money is yours, full stop. But with Bitcoin or other cryptocurrencies, if you lose your keys, there's no dedicated company or organization to help you recover your wallet. And you've seen many people over the past couple of years, they've tried to track down old keys and old Bitcoin, because if you can't find it, if you lose it, you just don't have it anymore. And that is a big problem. Okay, so that is a risk as well, loss of control. Then there are more rules on withdrawals. If you have a traditional savings account, you can withdraw your money and close your account at any time. Okay, but this may not be the case with your crypto savings account. For example, some cryptocurrency savings accounts have withdrawal limits that cap the amount you can take from your account over a specific period of time. These withdrawal limits can put money out of reach when you need it the most, like during a financial emergency. Again, we don't want to put our emergency fund here, because our emergency fund needs to be liquid. It needs to be available. It needs to be readily turned into cash. Okay, it needs to be readily used for whatever we need to use it for. Not only that, but you may also have to pay fees to withdraw your money. These fees can add up if you're an active crypto trader who makes a lot of transfers in and out of your account. Okay, and again, we want as little friction as possible. Emergency funds should be as little friction as possible for us, okay? We don't want to have to work to get our money. We don't want to have to pay a lot or anything really to get our money, okay? So we need to make sure that these types of things do not occur. Then another risk, obviously, is price volatility, okay? Price volatility is another significant item customers should be aware of. If the balance and interest is paid in a dollar-backed stablecoin, then it's easy to account for the interest being paid. However, if the balance and interest is paid in Bitcoin, then the total balance and payments will fluctuate according to market conditions. Okay, this means that the interest you earn could be worth more or less on any given day. That makes it hard to plan and to know if your account is truly helping you, quote unquote, get ahead. Robert Johnson, who's a PhD, CFA, professor of finance at Creighton, says that it's important to remember that cryptocurrencies are purely speculative vehicles. And I've told you this many times. Cryptocurrencies, as we know them right now, are speculation. Okay? Now, they may be smart speculation. They may be good bet speculation, but they are still speculative vehicles. They have no underlying fundamental value and suffer from many weaknesses as any sort of savings vehicle. They also routinely experience large price movements in a single day, which makes them a strange and risky asset to grow in a savings account. Okay. Of course, we want to put our money somewhere where it will grow. Of course, we want to try to make the most in interest that we can, but we also have to take the risks into account. And if you're going to invest, why not just invest? Okay. If you're going to do this where you're taking risk, where you're looking to make, 5, 6, 7, 8% returns, why aren't you just putting it in something like the stock market? Why aren't you putting it in, some index fund or an S&P 500 or something like that, right? Why are you going to something like a stable coin, which is far less proven, which is maybe just as volatile, if not more, if you're talking about crypto-backed stable coins and savings accounts. Okay. So you really need to think about what you're doing before you ever really jump too deep into the stablecoin idea. So, for example, Dogecoin traded at a high of 42.23 cents on April 20th, 2021, yet this cryptocurrency traded at just 16.37 cents 3 days later. That kind of volatility is not conducive to a savings account. If the underlying value is based on the fluctuation of the particular currency that is being used, then that's just not conducive to where you want your savings to be, where you want money that you're actually going to need to use. You don't want that money to be that much at risk. Then we also have what's called counterparty risk, and this is the last risk I'm going to talk about. You have to remember that these savings accounts are able to offer you such high yields because they are lending out crypto that you deposit at much higher rates. Again, this is what I was talking about a little while ago. That leads to some questions such as who's borrowing at 15 or 20 or more percent, justifying a platform paying out 12% on your assets. Okay, the risk to you as a depositor is that the platform or exchange you are utilizing suffers a wave of defaults on their loans that they can't cover. The result of a breakdown of the platform could be disastrous for savers with assets deposited. This may be a legitimate reason why the Federal Reserve is so worried about stablecoins and worried about crypto savings, because if somebody on one side of the deal is taking a lot of risk, okay, and it's going to impact how the other person may get paid out or may not get paid at all, okay, then that is something to actually worry about. That may actually break down financial stability, because as we've seen in our country many times, when lending standards decline, okay, and typically when lending standards decline, then you're getting really high rate debt, meaning if you have these particular borrowers that are very, very low quality borrowers, okay, and they are able to get loans, that means that the quality of the lending is going down. These individuals that are not as creditworthy, okay, still getting loans, they'll be getting loans at higher rates because the bank knows that they're taking on risk, and so they are giving money to these individuals at higher rates. Well, this kind of happened within the financial crisis when individuals who shouldn't have been getting loans in the first place were getting loans, and they were getting loans that they just ultimately could not repay. And when they couldn't repay them, then that impacted the value of the underlying mortgages, and then ultimately the mortgage-backed securities that were spread throughout the entire economy as a whole. Okay, so we've seen this have a widespread effect before. And so if you have so many people that are holding crypto, or so many people who are going into these stable coins and these crypto savings account and trying to reach for yield, which is really what they're doing here. Reaching for yield just means you can't find yield in one place, so you're going to take more risk in order to try to get yield in another place. Okay, so they may be going here to try to reach for some yield. Okay, the reason that the Federal Reserve would be worried about something like this is because they don't know the lending standards of these particular companies. They don't know what these companies that are lending money out at 15 or 20%, who they're lending that money to, or what those individuals are using that money for. Because individuals who are borrowing at those super high rates are likely not super creditworthy, or else they would just go to a bank and borrow at a very low rate because rates are extremely low right now. Okay, so there is some counterparty risk there, some very real counterparty risk that may make the Fed pause, may actually have them worry about these stable coins, because as long as you have individuals that are taking a lot of risk on the other side, that is them risking your money, which is why they can pay you a high rate on the other end. So don't get so caught up in the rates. Don't get so caught up in the fact that you can make 5, 6, 7, 8% on your money, right? look at why you may be making that amount of your money. And think about the fact that over a long period of time, the S&P 500 has made 10+% annually. Okay, if you look over the past 100 years, over 10% annually. Okay, and you think about the risk and the volatility associated just with the S&P 500. And then you wonder why would a stable coin or a savings account, a crypto savings account, be offering me, 7, 8, 9% on my money? Well, that risk must be similar to that risk of the stock market or that volatility of the stock market. And so you really kind of put those things side by side and you go, well, if I just wanted to take that risk, why would I not pick the thing that is more, proven, that's been around longer? Why would I pick this new thing that has a lot more hoops that I have to jump through? Now, I'm not saying that you should put your emergency funds in the market either. I told you before why that's a bad idea. Okay, but I think it is a particularly bad idea to put your emergency savings into a stable coin or some crypto savings account. Now, something else I want to talk about, though, is whether or not we should use these at all. Okay, should crypto savings account be something that you actually try to take advantage of? Now, the only situation that I think this might be something that you would try out is if you had excess savings. Okay, you have excess money laying around. Okay, you have your emergency fund, you're investing traditionally in a good amount, and you have excess savings that you would just like to put into a crypto savings account or stable coin and just, see what happens and allow that money to make some more interest than it would just sitting in the bank. I'm okay with that. All right, I'm okay with rolling the dice on some things, on having some speculation. I've told you before, a little bit of speculation is okay. Doing some things that, may actually make you a little more in the way of return, but you don't quite know as much about, you're taking a little more risk, that's perfectly okay if you have the excess money to do so. Okay, but if you don't have the excess money, you don't have a fully funded emergency fund, you aren't investing in traditional things like stocks and mutual funds, ETFs, things like that. If you're not investing in those things yet, and yet you're wanting to put money into crypto savings accounts, I don't understand. Okay, you need to lay the financial foundation for yourself. Now, I talked about this yesterday, and I think this is a big underlying theme of everything that I teach you guys on this show day in and day out. The underlying theme is that before you do anything too sophisticated, or you do anything too crazy, or you do anything that is too new or too unproven, you need to lay a financial foundation for yourself first. Or before you get into doing things that require you to take risk, let's get rid of some risk. Let's get rid of your debt. Let's get rid of the fact that you don't have any savings for emergencies. Okay, let's get those things off the table. Let's get rid of the fact that you don't know where your money's going. Let's actually budget and figure out where your money's going. Then let's start taking some risk. But then let's take calculated risks. Let's take smart risks. Let's do the things that are going to make the most sense for you over a long period of time. And I just think that right now, the idea of a crypto savings account or stable coins or whatever is just not something that I'm super interested in. It's not something that should be getting too much of your attention either, right? I think that you should stick to keeping your emergency fund where it is, investing when you're going to invest, and then otherwise, don't worry too much about saving, right, into something that is very risky, into something that has a bunch of underlying risk associated with it, just because you think that you can get some yield or some return. Okay, I understand that it sucks to put your money into a bank and the bank only pay 0.5% or even less, right? I understand that that's no fun, but what's even less fun is you having $15,000, $20,000, $30,000 in a crypto savings account because that's your emergency fund, and then you not being able to get your hands on that money, and an emergency arising and you not being able to access the money that you have. Okay, that's the last thing that I want for you guys. I want you guys to be able to get your hands on that money. So keep it where you can actually deal with it. Right now, we're not widely paying for things in crypto. We're not widely using crypto markets for transactions as much as we may in the future. Okay, but right now, if you have that money in cash in your accounts and you can just pay for something quickly, that's what you want out of your emergency fund. And if you're going to invest, but do so in proven ways. Do so in ways that are, over the long term, showing that they will make you higher rates of return with a reasonable amount of risk, and that's something that you understand. It's far more difficult to understand crypto savings accounts or the stable coins than it is the stock market or individual stocks or things of the like. Okay, so just do your homework, understand what you're doing, but for now, let's try our best to not get too aroused by the idea of crypto savings accounts or stable coins, because over the long term, they may actually provide some value. But right now, that value is actually just found in a whole lot of extra risk that may not be necessary to take. So thanks for watching this episode. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcast, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards some long-term financial goals that we have for you, and then pushing you towards long-term financial freedom, which is what I hope for every single individual who is watching or listening to this show on a day-to-day basis. So tune in tomorrow as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.